Welcome to Mission Wealth's Market Perspectives for the second quarter of 2018. My name is Kieran Osborne, and I'm the Chief Investment Officer at Mission Wealth. I'm excited to be presenting to you today. This presentation will cover three broad themes: market volatility, equities in the economy, and fixed income. Volatility has risen somewhat dramatically year to date, and two primary factors have been cited as driving it higher. The first, inflation and interest rate concerns, and secondly, the threat of trade wars. However, we would argue that the market may be transitioning towards a more normal environment, and elevated levels of volatility are a natural byproduct of this development. With the recent stock market sell-off, global equities are trading much more in line with historic averages. In fact, international and emerging markets appear to be trading below their historic averages and may offer more attractive valuation opportunities. Fundamentals continue to be sound, and we are continuing to witness strong synchronized global growth. The likelihood of a near-term recession also appears relatively low. With regard to fixed income, the Fed has communicated a commitment to normalizing monetary policy, both by increasing interest rates and shrinking its balance sheet. At the same time, because of recent tax reform, the supply or issuance of treasuries has been increasing. We believe these dynamics may put upward pressure on interest rates and downward pressure on bond prices as a result. The S&P 500 experienced its first negative quarter in the first quarter of 2018 since 2015. So what's driving this market volatility? Well, as the chart on the left-hand side, top left-hand side shows, the first material market sell-off of the year occurred at the end of January and was largely attributed to inflationary fears and the risk that the Fed would tighten more aggressively and potentially derail the current economic expansion. At the beginning of the year, market implied estimates for the Fed funds rate showed an expectation for just 2 Fed rate rises in 2018. We believed 3 or even 4 rate rises were possible. As inflationary pressures rose, expectations increased and interest rates moved higher. Ultimately, we are moving away from a world where easy monetary policy, such as quantitative easing and historically low interest rates, acted as a natural tailwind for stocks. And we're moving towards an environment where that proverbial punch bowl has been taken away. We've never experienced a situation quite like this before, and as a result, volatility may be a natural outcome. The second market sell-off was caused by fears surrounding tariffs and trade wars. Trade wars are widely considered to be a bad thing for all parties involved. The results tend to be a tit-for-tat of retaliatory actions that ultimately hurt consumers in all countries involved. To the extent that the current trade war narrative continues, it is only likely to provide heightened uncertainty and volatility for financial markets. But we may also be transitioning to a more normal environment. What do I mean by that? Well, 2017 was simply not a normal market by historic standards. Volatility is part of the course for an investment in equities. This is a nice chart. It just depicts that over the years, the average intra-year sell-off in the S&P 500 is around 14%. Despite that, more than 3/4 of those years, the S&P 500 returns a positive return. We only got the largest sell-off in 2017 happened to only be 3%. So what does a normal stock market year look like? Again, an average intra-year decline of 14%, but still positive, more than 75%, 76% of the time. At least one minus 10% sell-off, and at least 5 minus 5% sell-offs. Multiple plus or minus 2% daily moves in the S&P 500 in any given year. None of this happened in 2017. In fact, you have to go all the way back to 2005 for a year that did not have any plus or minus 2% daily moves in the S&P 500. So we believe 2017 was highly unusual by historic standards. In comparison, the current environment with elevated levels of volatility is not that unusual, and we may simply be transitioning towards a more normal market environment after experiencing an abnormal market environment in 2017 and recent years. Again, volatility goes hand in hand with investing in stocks. However, many investors have become conditioned and accustomed to the recent low levels of volatility. And thus the current elevated level of volatility, volatility in the current environment has come as somewhat of a surprise. Again, the S&P 500 experienced its first negative quarter since 2015, as depicted in the chart above. Despite this uptick in volatility, the one-year returns still are very strong, with international and emerging markets experiencing relative strength versus US stocks. Despite this relative strength recently over the one-year period, we still believe international and emerging markets offer attractive upside potential relative to US stocks moving forward. And I'll speak to that in a second. With the recent sell-off, US stocks now appear much more fairly priced. They had been somewhat overvalued, as this chart depicts, but now, based upon a 16.4 times price to earnings multiple versus a 25-year average of just over 16 times, US stocks do appear much more in line with their historic averages. Part of this has been a function of the market sell-off. Another part of this has been the fact that earnings expectations have been elevated due to recent tax reform. But ultimately, US stocks are now trading much more in line with their historic averages. On the other hand, we still see relative value in international and emerging market stocks, despite the recent outperformance. You'll see in this chart here that with the recent sell-off, international stocks are actually trading below their long-term average at about 13.3 times on a price to earnings multiple versus a longer-term average of 14.5 times. International and emerging markets are yet to surpass their pre-2008 levels, and we think there's more runway left within international and emerging markets. There's been a lot of discussion around trade imbalances and the trade deficit, specifically with China. But we believe one of the ways that that trade imbalance can be corrected is via a weaker US dollar moving forward. And if that comes to pass, that should also benefit international stocks. Looking at earnings growth and earnings expectations for 2018, expectations are for very strong earnings growth of approximately 25% through 2018. That's very, very strong. And you can see that profit margins continue to expand. This is really a function of the ongoing economic strength we're experiencing, but also be due to the tax benefits that are accruing to the bottom line for US companies. Economic growth in the US is expected to be around the 3% level for the next 12 to 18 months. And we may get a stimulus in the second quarter of 2019 as bigger or larger than expected refunds flow in. But we do anticipate that the economy may cool in the latter half of 2019. There's just simply not enough slack or growth in the labour force. The unemployment rate simply cannot drop much further than where it is currently. And the labour force itself is just not growing enough to sustain ongoing 3% growth. We anticipate growth to fall more towards the 2% level in the second half of 2019. With that being said, based on historic data and current economic levels, we do not anticipate a recession to hit in the US for at least another 2 years. And we are continuing to see very strong synchronized global growth. This chart here, the short of this is green is good, and you see a lot of green in this chart. It depicts global purchasing managers' index for manufacturing. But clearly a lot of green in the chart on the right-hand side, depicting very strong global growth, ongoing very strong global growth. At the same time, inflation rates appear to be fairly well contained globally, which should help continue to support global growth moving forward. So what does this all mean for the expectations for stocks? Well, moving forward, given the sell-off and the fact that US stocks are trading more in line with their historic averages, we are somewhat constructive, and partner research supports this view with expectations for low double-digit total return over the next 12 months for the S&P 500. But we are more positive on international and emerging markets, as depicted in the same chart, with total return expectations outpacing US stocks for emerging markets and international stocks. Inflation continues to be relatively contained despite a recent uptick in inflation. We don't anticipate that inflation is going to be a primary driver of Fed policy moving forward. Rather, we believe that the Fed's desire to normalize their monetary policy is going to be the leading driver of monetary policy itself. Essentially, the Fed wants to create a buffer if and when we experience the next recession for them to be able to cut rates at that point in time. Inflation may push marginally above 2% by the end of the year. We don't anticipate it to exceed substantially 2%. But we do note also that the Fed has communicated their inflation target is symmetric around that 2% target rate, meaning that they are not managing monetary policy or managing inflation to be 2% or less, rather 2% plus or minus. So they may allow inflation to exceed 2% marginally over time. I touched on this earlier, but market expectations for the Fed funds rate have increased from the end of last year, beginning of this year, to an expectation for 3 Fed funds rate rises in 2018. They had previously expected just 2 rate rises. And FOMC member forecasts imply another 3 rate rises in 2019. So clearly we are on the path of normalization from an interest rate standpoint, with definite upward bias toward on interest rates moving ahead. At the same time, as the Fed is raising interest rates, they also continue to shrink their balance sheet, as depicted in this chart here. While the Fed is shrinking their balance sheet via not reinvesting maturing securities back into the marketplace, the Treasury is actually increasing its issuance or increasing the supply as a result of recent tax policy. So essentially, we've got this dynamic moving forward where you have an increase in supply and a decrease in demand, which naturally tends to put downward pressure on prices, or bond prices in this instance, as a result. So we anticipate that interest rates should grind higher from where we are currently, and bond prices may come under pressure going forward. And that's borne out in the median consensus estimates for interest rates in the US. You can see in this top chart here that by the end of 2018, consensus is for the US 10-year to be at 3.15% and at 3.5% by the end of 2019. So with this outlook for an increasing interest rate environment, it's very interesting that interest rate sensitivity of the broad fixed income market is actually at its highest level in 30 years, and that's depicted in the chart below. The duration of the Barclays Aggregate US Bond Market Index is right around just over 6 years, the highest level in 30 years. And that's really a function of a lot of companies taking advantage of the ultra low interest rate environment and refinancing to longer and longer maturities and locking in those low interest rates. Importantly, Mission Wealth has maintained a duration profile lower than the broad market and in line with the historic average of around just under 5 years, given our view that interest rates are likely to grind higher from this point forward. So, given a backdrop of a rising interest rate environment, which asset classes within fixed income get impacted the most by a rising interest rate environment? Well, this chart here just depicts the impact of a 1% rise in interest rates, and unsurprisingly, long duration treasuries, 30-year treasuries, get hit the worst. Conversely, satellite fixed income, such as high yield floating rate, tends to outperform under a rising interest rate environment. We have a dedicated allocation to satellite fixed income. However, we do caution on valuations because credit currently is relatively expensive by historic standards. As an example, US high yield is currently trading at the 96th percentile, so it's very expensive relative to historic valuation standards. So, faced with an elevated levels of volatility, of market volatility, relatively expensive valuations, and the fact that we are in the late stages of the current economic expansion, we have reduced somewhat our exposure to credit within our fixed income allocations. So with this global backdrop, what actions are we taking? Well, first and foremost, stay diversified. Don't let emotions dictate investment decisions. Empirical evidence shows that taking a disciplined, long-term approach to portfolio construction and rebalancing adds value over time. We continue to favor a globally diversified allocation to equities with dedicated exposures to international and emerging markets, both of which we believe have the potential to outperform US stocks moving forward. Within fixed income, we have reduced our overall credit exposure and are favoring higher quality satellite fixed income. High quality, high yield bonds is a good example. We are also very carefully managing our interest rate sensitivity and maintain a shorter duration profile than the broad fixed income market as a result. We believe our portfolios are well positioned for the forthcoming period, offering a globally diversified portfolio that may weather the potential for elevated market volatility, a rising interest rate environment, and the ever-changing geopolitical and economic landscape. Thank you for listening to this presentation today. If you have any questions, please reach out to your client advisor.